Namaste and welcome to an overview of variance analysis as a part of standard costing. Standard costing has got two components, standard and costing. We have to understand the meaning of each of these and how it affects the whole analysis of variances. To take the word standard, standard is a benchmark, is a norm, or is an acceptable measure of performance. And what do we do with the standard? We compare the actual performance. Everybody is supposed to meet the standard or exceed the standard. Any performance below the standard is known as substandard performance, which needs improvement to keep the business in a competitive mode. To take standard in its details, it is a predetermined measure of quantity. Predetermined means decided in advance as a benchmark, and it takes care of all conditions that facilitate the performance. It is not theoretical. It takes care of the conditions prevailing under which the performance could be achieved to standard. It may be for an element of work or a list of operations or a set of activities. It covers a huge lot of activities. For each part of work, for each part of operation, for each part of activity, there can be a standard. Normally, it is referred in respect of manufacturing most of the times. And these standards are carefully evolved because they have got impact on the motivation and morale of the staff. If you set a very high standard, if it is not achievable, we will be failing in our purpose of profit optimization. Therefore, a standard has to facilitate performance, it has to encourage performance, and it has to motivate people to exceed in terms of their achievement. And what they normally do is, standards are evolved after a detailed study and after ensuring that the process is simplified, the process is standardized, there is no taking of chances. And it can be pertaining to simplification and standardization of products, methods, and operations so that it is accepted as an achievable benchmark by those who are involved as a part of their work profile. And standards are set in advance to ensure that the waste of resources are fully eliminated and we get the best of performance and the maximum of productivity and profitability, which benefits all the stakeholders. Now coming to standard costing, we are talking of costing. What is standard costing? It is a multi-layered process. Broadly, it involves preparation and use of standard cost, comparison with the actual cost, and measurement and analysis of what is the difference between the two and what are the reasons for the same. And it doesn't stop at the reasons or causes. It goes into the bottom of it and finds a solution to the problem. Means standard costing is aiming at identifying the loopholes in the system and ensuring we get the best of productivity, and we are always up with full simplification, full standardization of methods and operations. If we put it in the form of stages, standard costing and variance analysis involves preparation and use of standard costs. For each item or element of cost, there is a standard which is set. We evolve standards, publish it, then we measure and record the actuals. And once we have two sets of A, the standard, B, the actuals. We compare the two, and A versus B, we find out the variance, difference between the two. How far is B from A? Then as a fourth step, we analyze why the difference. What may be the reason for this? Once we analyze, we use it for correction to achieve the right performance going forward. Therefore, this is not only problem solving, this is futuristic in approach. It wants to have permanent improvement in the process of operations, be it in terms of products, methods, or operations. And standard costing is always forward looking in approach, and it is improvement on a regular basis after recording the actuals, comparing it with the standards, ascertaining the variance, analyzing the same, and taking corrective action. Going forward, we need to understand what are the types of variances. When we study variances, we said standard costing. Do you really mean only costing? Only cost? Are you looking into anything else? If we look into, when we analyze, it is not only a matter of cost. We also have standards for sales. We also have standards for profits as a part of our budget. Therefore, when we study the variances, we study variances of sales, variances of cost, and variances of profit. And whole with the intention of maximizing the revenue and minimizing the cost or optimizing the cost. And when we talk of cost, we talk of material, labor, variable overheads, and fixed overheads. And how does it work? For example, we are a company. We have 3 products. We make a sales budget. We say for a particular quarter, we need to sell 1000 units of P, Q, R, say 500, 400, and 100. This is the standard quantity. And we want to realize a sale proceed of 30, 20, and 50. This is our standard price. Standards for quantity to be sold, standards for price to be realized. Therefore, my standard sales value for the quarter has to be 28,000 rupees. 15,500 into 30 to come from P, 8,000 to come from Q, and 5,000 to come from R. This is my product mix. This is my product quantity. This is my product price, and this is my product value. And you will also find there is a ratio between these 3. We will be getting 15,000 from product P, 8,000 from product Q, and R contributes 5,000. This is so far as the standards is concerned. We say first evolve standard. Then we take the actuals. When we got the actuals, instead of selling 9,000, we sold 950. Instead of 30, we realized 40 from P. Therefore, our sales went up from 15 to 16, although our quantity came down from 500 to 400. Q, we sold 500 instead of 400. We sold at 10 instead of 20. We realized 5,000. We sold 50 of R as against 100 standard, and our realization is 2,000. Our revenue to be realized was 28,000. We realized 23,000. For what reason? We have to analyze the variance. When we analyze, what do we get? When we analyze, we will analyze the elements of variance. If we take the variance, the first variance that we will see is, was there a change in the price? Yes, there was a change in the price, 40 versus 30, 10 versus 20, 50 versus 40. It may be a rate, it may be higher or lower. We are talking of the sales price. And it may be volume also. We were to sell 10,000 pieces, but we sold only 950, 50 pieces short. That is the efficiency or usage. We will get into that. And this volume will have 2 portions, mix Have a look at it. We were supposed to sell 500 plus 400 plus 100 as a mix. But what we sold was 400, 500 plus 50. This is the mix. Yield. A was supposed to contribute 15,000, but it contributed 16. Q was supposed to contribute 8,000, but it contributed 5. R was supposed to contribute 5,000 rupees, it contributed 2,000. There is a yield from each of these which is varying. Therefore, when you talk of variance, there will be variance of price, there will be variance of quantity or volume, and there will also be variance of mix and yield. These are the two major variances, and this is a sub variance which is measured and to understand better what went wrong. Now the question comes, when you talk of variance, what are the two types of variances? Variance, one is adverse variance, the other one is favorable variance. When your revenue goes up, it is a favorable variance. If sales goes up, it is favorable. For example, in case of P, revenue goes up from 15,000 to 16,000, I am having a favorable variance. In case of Q, my revenue was supposed to be 8,000, it has come down. Therefore, when revenue goes down, it is known as negative or adverse. Take the case of total. We were supposed to make 28,000 of sales, but we made sales of only 23,000. Means it is adverse because our sales revenue has come down. Take the case of cost. In case of cost, the interpretation is reverse. When you reduce your cost, it is favorable. If you were supposed to incur 1,000 rupees and you finish the job in 900, you have reduced the cost. When cost is reduced, it is called a favorable variance. When the cost goes up, instead of coming by train, you came by flight and you cost the company 10,000 rupees instead of 1,000. Your cost has gone up. There is an adverse variance. Now this variance analysis helps you understand fully how and where the difference is coming, what is the reason. Now for the variance to be valuable, standards have to be pakka. Therefore they say for standard costing, first simplification, standardization, study of all conditions, and then only you set the standard. And that becomes the norm. That is the acceptable performance. Measure, acceptable measure, weights and measures. 1 kg means it has to be 1000 grams. If your kg itself is not 1000 perfectly, and if it is not calibrated scientifically, then the standard costing doesn't work. Therefore, the standards are to be pakka, and then against standard we compare the actuals and we derive the elements, and we analyze elements into price and volume into mix and yield. That gives us a feel so that we can rectify the situation, and going forward we can implement improvements in the system and enhance our productivity. Going forward, as a part of the variance analysis, we will be looking into sales variances, material cost variances, labor variances, fixed overhead variances, and variable overhead variances, and all of them follow almost a single simple template which we will be using in each of these, and we will have working solutions under each of these heads. We will continue with the variance analysis under its various components. Hope you liked the presentation. Thank you so much. Thanks a lot.